Hello everyone, Joe Vitale, American Retirement Advisors with the Gradient Investments weekly talking points for the week ending December 16th, 2022. Let's get into it. Equities were down across the major global indices after the Federal Reserve raised interest rates and commented on higher rates to come. Additionally, data this week showed a picture of declining industrial production, manufacturing, and services along with retail sales. The S&P declined 2.05%, the Russell 2000 was down 1.81, and the NASDAQ was down 2.7%, all lower for the week. Overseas, the developed markets, which is the EFA, was down 2.13, and the emerging markets dropped 2.09. In the U.S., energy and utilities were the best performing sectors, while this consumer discretionary and technology were the biggest laggards. In fixed income, the Federal Reserve raised its benchmark policy rate by 0.5%, breaking the month-long streak of 0.75 that has been raising over time. Interest rates increased and marking the start of a new phase of policy tightening. With that increase, the federal funds rate's new target range is 4.25 to 4.5%, as the Fed attempts to reduce the rate of inflation to a sustained 2%. It remained hawkish in the statement that referenced the pace of future increases. They ended the week with a 3.48% yield, down 9 basis points. Now, really, the Fed is probably going to continue to raise rates. We're already talking about it. Probably they want to get to that 5% rate, which, because they're not, what's going to happen is we're going to have to see the rates go up to reduce the spending, to reduce the inflation. Until that happens, they are going to get it into inflation, a recession. They do want a soft landing, but the rate they're raising rates is actually kind of, they should have done it a long time ago, slowly, but because they're raising it now to try to get the inflation down, we are going to see things tightening. We are going to see recession. How bad? Shouldn't be too bad. Let's hope not, but who knows? We'll see what happens. Oil prices continue to climb on optimism that Chinese demand will surge post-COVID restrictions, because you know how China always shuts down as soon as anybody breathes. So additionally, the shutdown of the Keystone Pipeline following an oil leak in Nebraska contributed to substantially the latest price movement that saw West Texas crude go up 4.85% last week to $74.46 per barrel. Now, economic data, the CPI, which is a consumer price index, moderated to an annual pace of 7.1% in November, lower than the consensus forecast and down from the 7.7% rate in October. Compared to the previous month, overall CPI rose 0.1%, which was lower than consensus estimate and below the 0.4% increase in October. After excluding volatile food and energy, the annual rate was 6%, down from 6.3% in the prior month. The industrial production declined 0.2% in November, below the consensus estimates for 0.1% gain. Manufacturing dropped 0.6%, while utilities rose 3.6%. Capacity utilization for manufacturing fell 0.6%. What does that mean? A bunch of numbers and a bunch of jargons. It means things are slowing down. That's the bottom line. What we're saying, retail sales declined 0.6% in November versus the prior month, below the consensus expectations for 0.2% decline. After excluding volatile vehicles and gas, sales were down 0.2% versus expectations for 0.1% drop. The only two categories to show meaningful month-over-month growth were restaurants and grocery stores. Of course, because the costs of goods are going crazy, plus people are still going out like crazy right now. Company news, CVS, which is a G50 holding, announced a 10% dividend increase. We talk about that, G50 increase, yield. Yield on the new dividend is 2.5%. Nestle SA, which is a G40I holding, announced it will invest $42 million in new food manufacturing in Western Ukraine to supply the local market and markets in Europe. Nestle is a Swiss firm with about 5,800 staff in Ukraine, is planning to add 1,500 new jobs with this new facility. This marks the first major private investment in Ukraine since the Russian invasion, but shares were down 1.53% for the week. And Netflix, which is a contrarian choice, Core Select and G33 holding, dropped 9.16% last week after the company allowed some advertisers to claim a refund after missing some viewership guarantees on its new ad-supported services. And you're seeing Netflix as part of the big tech. You're seeing tech just get nailed this year. But we're still seeing, their G33 portfolio, contrarian choice portfolio, which are more tech heavy, more growth, they're way down this year compared to the G50, which is more value based and more blue chip stocks with dividends, which is, barely down maybe 5, 6, 7%. So much better overall. But we are seeing some opportunities. Are we at the lowest point? Could we go a little bit lower? Yes. But how are you going to market time? So that's why it's good to stay invested, make sure we've got cash available, like we have the income coming in, the safe money, and then our growth money. Because we're going to see this go up and down, but we are going to see long term. We're going to get out of it. I think probably the next 12 months is hopefully what we're looking at. So we should start seeing some sustainable growth once we go through this little recession that hopefully doesn't get too bad. That's it. That's it for this week. We thank you for being part of the ARA family. To contact us, of course, 855-756-5700. Visit us at aradvisorsinc.com. Don't forget to visit our Facebook and YouTube pages. Scan our QR code to get the newsletter. Share it with friends. God bless you. Have a wonderful, wonderful Christmas and a blessed time with your family. And we will look forward to seeing you again next week.